Greetings to all our IMAPS clients and investors. Let me walk you through the latest changes made during the first week of January. The US equity market closed 2024 as one of the best years in economic history. The Fed remained consistent in its well-telegraphed path towards lower rates, at the same time leaving the door open to pause sooner than expected if conditions require a more hawkish approach. Undeniably, 2024 was a year that will have its own chapter in future economic books, perhaps exemplifying the first instance of economic deceleration without a landing or recession. Within that context, credit metrics, labor market, and to a certain extent, consumption figures have declined from all-time high levels, but not to the point of concern. Our proprietary recessionary indicator is assigning only an 11.64 recession probability in the US the next 6 months. It is reasonable to expect a more volatile first half of the year, where the market will have to parse, dissect, and adapt to the policies that the new administration is expected to implement. Decisions related to tariffs, massive deportations might have an inflationary impact which could derail the Fed's ability to continue cutting rates. However, regulatory easing, a broadening of AI-related capital spending, and a change in energy policies could further support US exceptionalism. One of the biggest questions for 2025 revolves around the direction of the US fiscal deficit. Ex ante, it is expected to worsen as a result of combinations of actions such as tax cuts and other fiscal benefits, as well as an increment in government spending. This could be partially or completely offset with the drastic optimization and cost savings plans that Elon Musk is proposing to deliver, although it remains unclear how and when these are going to be implemented. We have reduced the allocation to long-dated treasuries given the more uncertain environment in the long end of the yield curve, brought about by the worsening in the US fiscal deficit. As a result of the previously mentioned changes, we have increased the allocation to investment-grade mid-maturity corporate bonds to expand the allocation in the value of the curve, making the portfolio less exposed to yield curve steepening. Furthermore, we are introducing a new active manager within the investment-grade space, specialized in G10 fixed income securities. The manager has a persistently low correlation with major investment-grade sub-asset classes such as global, US, and Euro treasuries, as well as global aggregates. The positioning is expected to enhance the risk-adjusted performance of the portfolio. At the same time, we have reduced the allocation to global aggregates and asset-backed securities, where the net effect in the investment-grade portion of the portfolio is to maintain a constant allocation to asset classes. The allocation to high yield, on the other hand, was changed from underweight to neutral. Credit risk metrics provide a good support for the asset class, which, combined with private credit providing ample liquidity on the sidelines, could act as a shock absorber in case of unexpected widening in the current spread levels. The shorter duration with respect to investment grade also serves to reduce the overall portfolio duration, minimizing yield curve steepening risk. Finally, preferred shares were swapped for high yield, given the more favorable outlook for the asset class. On the US equities front, we have introduced an active large cap blend manager to the mix. The manager has a dual allocation to growth and value companies, with a 20-year track record not only outperforming the S&P 500 index, but also displaying a persistent lower historical level of volatility than the index. The rotation of assets into this manager comes from reducing the allocation to passive and value-only managers, as well as reducing the exposure to real estate in the portfolio to neutral. The allocation to long-short active management in Europe was augmented to account for the subpar growth outlook for the region, divergence across European economies, and the risk of new tariffs on export in European exports, which requires the need for a strategy that could profit in a broad range of market scenarios. The allocation to Japanese equities was adjusted to match the benchmark allocation. Finally, we remain underweight in Asia and emerging markets, while maintaining an overweight to US equities, where we expect the former to continue to outperform in relation to the latter. We hope you are well, and as always, please reach out to your financial advisor or investment professional with any questions you may have. Thank you.